The fault line ledger. Every collapse has a paper trail, and we decode what it reveals. The architecture of control. A financial autopsy of Canada's grocery monopoly. Subject: George Weston Limited and Loblaw Companies Limited.
In 2022, the average Canadian consumer watched the cost of food purchased from stores rise by 9.8%. It was the fastest pace of inflation recorded in the grocery aisle since 1981. Loblaw's public defense relies on the claim that grocery is an exceptionally low-margin business, netting only about 3% profit. Under this logic, price hikes at the register are simply a mathematical necessity driven by increased supply chain costs. This chart shows a different story. The gross profit margin expanded from a pre-pandemic average of 24.4% to over 32%. Executive wealth surged in tandem. Galen Weston's compensation jumped to nearly $11.8 million, while net profits leaped 168%. Standard inflation does not account for a company expanding its profit margins while its customers struggle to afford basic goods. This wealth transfer is the result of a corporate architecture designed for total market control. Control begins at the shelf. For 14 years, Loblaw and its parent company, George Weston Limited, participated in an industry-wide price-fixing conspiracy that kept the price of packaged bread artificially high. The cartel used a mechanism called the 7-10 convention. As this flow graphic illustrates, a 7-cent increase at the wholesale level would trigger a coordinated 10-cent increase at the retail level across the market. Loblaw secured immunity from criminal prosecution by self-reporting the scheme, and later settled civil suits for $500 million. It was a legal resolution that cost the company only a fraction of the profits generated over that decade. Upstream, the company utilizes monopsony power. Because of its massive scale, Loblaw acts as a single dominant buyer that can dictate terms to thousands of individual suppliers who have few other ways to reach the Canadian public. Suppliers are forced into a pay-to-play model. This ledger details the mandatory costs, from $15,000 slotting fees per product to punitive out-of-stock fees that can reach $20,000 a month. To survive these mandatory retail fees, suppliers must raise their baseline prices. Ultimately, the Canadian consumer pays the higher shelf price that subsidizes Loblaw's extraction of capital from the supply chain. Physical control of the market is managed through Loblaw's real estate arm, Choice Properties, which owns a vast portfolio of commercial land where Canadians shop. As a landlord, the company inserts property controls, such as restrictive covenants and exclusivity clauses, directly into commercial leases. These clauses protect Loblaw's territory by legally forbidding competing grocery chains from leasing space in the same commercial zones or neighborhoods. The final pillar of control involves the state itself. Starting in 1992, Loblaw utilized Glenhuron Bank, an offshore subsidiary in Barbados, to manage its international financial operations. Glenhuron Bank managed corporate banking and investments, shielding hundreds of millions of dollars in income from the Canadian tax base. The Canada Revenue Agency launched a decades-long legal challenge to reclaim these taxes, arguing the offshore structure was an attempt to avoid domestic tax obligations. In 2021, the Supreme Court of Canada issued a unanimous 7-0 ruling in favor of Loblaw, confirming that its offshore tax strategy was entirely legal under existing provisions. Loblaw's most potent competitive advantage is its ability to out-litigate and outmaneuver the state's regulatory and tax frameworks. These 4 pillars form a closed-loop corporate ecosystem, a company that bakes the product, controls the retail shelf, owns the land, and routes the resulting profits through offshore tax structures. In 2024, the Competition Bureau began utilizing new legislative powers to investigate these property controls and retail fees. These government probes are launching only after this structure of market dominance has been deeply entrenched for decades. The expansion of gross margins to over 32% is the intended mathematical output of this closed-loop system, rather than an accidental byproduct of global inflation. The protected wealth of the Weston family remains insulated from the economic shocks that have left the average Canadian in a state of financial vulnerability. Characterizing the current crisis solely as greedflation overlooks the structural reality. The Canadian public functions as the primary funder of a corporate ecosystem that has successfully insulated itself from market competition and domestic taxation.
Next time you buy a $4 loaf of packaged bread, I want you to look really closely at the receipt.
Yeah, just take a second and actually look at it.
Exactly. Because what feels like a simple everyday transaction is actually the final step in a meticulously engineered 140-year-old machine.
Right. A very deliberate machine.
A machine designed to ensure that you never really had a choice in what you paid, where you bought it, or, who ultimately profited from it.
Which is exactly what we're unpacking today.
Yes. Today, we're doing a deep dive into a massive stack of source material. We've got decades of financial disclosures, legal filings, Competition Bureau reports, and Supreme Court of Canada judgments.
It's a mountain of paper.
It really is. And we are mapping the exact anatomy of a Canadian monopoly. And look, the numbers are staggering, but we aren't here to sensationalize them.
The facts are chilling enough on their own.
Exactly.
Yeah.
We are just going to lay these documents on the table, look at the cold mechanics of how the system was built, and let the facts speak for themselves.
And to understand the mechanics of what happens at the checkout counter today, we really have to trace the architecture back to its foundation.
Right back to the beginning.
Yeah, we have to look at how a single horse-drawn bread delivery route in 1882 evolved into this impenetrable corporate fortress, one that essentially dictates the geography of food in an entire country.
Okay, so let's start right there. We're looking at George Weston Limited and its primary retail engine, which is Loblaw Companies Limited.
Right.
The origin point is 1882. A man named George Weston buys 2 bread delivery routes in Toronto.
Just 2 routes.
Yeah, super small scale. But by 1896, he opens the model bakery. And by 1910, he merges his operations into something called the Canada Bread Company.
Which is a huge leap.
It is. It starts with the absolute most basic staple of the human diet.
And that transition from buying delivery routes to building the model bakery in 1896, that is really the first major pivot we need to look at.
How so?
Well, at that time, food production was highly localized. You bought bread from the baker on your specific street.
Right. There were no mega factories.
Exactly. Weston realized that if you transition from local baking to industrial food production, you capture massive economies of scale.
You can bake way more bread for less money and distribute it wider.
Right. But the true structural genius of this empire, the thing that completely altered the trajectory of the company, it actually didn't happen in the bakery.
It happened in retail.
Yes. In 1919, with the opening of the first Loblaw Groceterias store.
Right, because before 1919, going to the grocery store was a completely different experience for you as a consumer.
Totally different.
You didn't walk the aisles. You walked up to a wooden counter, handed a written list to a clerk, and that clerk walked around the back of the store gathering your flour, your sugar, your canned goods.
It was a highly labor-intensive process for the store owner.
Yeah. What Loblaw introduced was the self-serve retail model.
And think about the underlying economics of that shift. By letting the customer walk the aisles and pick their own items off the shelf, the groceteria model fundamentally shifted the physical labor of gathering goods
onto the consumer.
Exactly, onto you, the shopper. It drastically lowered the overhead costs of operating a store because you needed far fewer employees.
Which means higher profit margins.
Yes, but more importantly, it changed the psychology of shopping.
Oh, because of impulse buying.
Precisely. If you have to ask a clerk for every single item, you only buy exactly what is on your list.
Right.
But if you are walking past shelves packed with goods, you browse. You buy things you didn't plan to buy.
Okay, so they figure out industrial production on the Weston side.
Yeah.
And they figure out high-efficiency retail on the Loblaw side.
Right.
But these are still separate entities at this point. When does the actual empire start to take shape?
That happens in 1953. This is when W. Garfield Weston, who is George's son, acquires a controlling interest in Loblaw Groceterias.
Okay, so the bakery buys the grocery store.
Yes. George Weston Limited, the baking company, which had already gone public to access international capital, was now fusing its industrial food production with mass retail distribution.
So this is the birth of vertical integration in their supply chain. They own the bakery, and they own the shelves the bread sits on.
Exactly. And let's break down why vertical integration is so incredibly powerful. It isn't just about moving products from point A to point B more efficiently.
Right, it's about the money.
It is about capturing the profit margin at every single stage of a product's life cycle. Think of a supply chain as a staircase.
Okay, a staircase.
And at every step, somebody takes a percentage as profit. The farmer, the miller, the baker, the distributor, the grocery store.
Everyone needs their cut.
Right. But if you own the baker, the distributor, and the grocer,
You aren't paying third parties. You are just moving money from your left pocket to your right pocket.
And capturing the entirety of the economic value generated by that loaf of bread. You are essentially paying yourself to stock your own shelves.
That is exactly how it works.
I have to push back here for a second, though. I'm looking at the source documents regarding the history of the 1950s and 1960s.
Under George C. Metcalf.
Right, under the leadership of George C. Metcalf. The company is expanding voraciously. They're buying up competitors everywhere. National Tea, Kelly Douglas, Atlantic Wholesalers.
Huge acquisitions.
Yeah, and the documents describe this era as operating behind a, quote, veil of accounting obscurity.
A very deliberate veil.
Well, that's my question. They were nesting holding companies inside holding companies, taking on massive debt to fuel these buyouts, and keeping it totally opaque.
Yes, they were.
But isn't a highly complex corporate structure just the natural evolution of a business that is growing aggressively?
You'd think so.
But why do historians and regulators look at this specific opacity as a strategic shield, rather than just messy bookkeeping?
It's a fair question, but we have to look at the context of financial regulations at the time. Today, publicly traded companies have strict reporting requirements through securities commissions.
Right, you have to disclose everything.
But in the 1950s and 60s, the reporting standards were incredibly lax. The opacity wasn't an accident, it was a strategy.
How extreme was it?
It was so extreme that financial analysts on Bay Street couldn't actually evaluate the stock because they fundamentally didn't know what the company owned.
Wow.
Even high-ranking executives within the subsidiary companies did not know which corporate entities belonged to George Weston Limited and which belonged to Loblaw.
That is wild. It's like a corporate matryoshka doll. You open one holding company and there's just another holding company inside.
Precisely. And the strategic value of that matryoshka doll is that if the public, the shareholders, and most importantly, the antitrust regulators cannot accurately map your assets.
They can't regulate your market power.
Exactly. By keeping the debt hidden in unlisted subsidiaries, they could aggressively buy up competitors across the continent without triggering monopoly alarms.
So they were flying under the radar while building a massive footprint.
Yes. By the time Weston was forced to reveal the true breadth of its holdings to the public in 1966, the consolidation was already complete. The market was already captured.
But that strategy almost killed them, right?
Yeah.
Because the debt caught up to them.
It did. By the early 1970s, Loblaw's was rapidly losing market share.
They were carrying $80 million in debt, and they were staring down bankruptcy.
Which is when the third generation, W. Galen Weston, is brought in to essentially stop the bleeding.
He closes underperforming stores, modernizes the operation, and saves the company.
He stabilized the ship, and that eventually paved the way for the modern era under the fourth generation of leadership, Galen G. Weston.
Right, the current era.
And under his tenure, we see the absolute culmination of this vertical blueprint.
Okay, let's look at the timeline here.
In 2018, they spun out their massive real estate portfolio into a separate entity called Choice Properties.
Which we'll dig into later because that's huge.
It is. And then in 2021, they did something that seems completely counterintuitive if you look at their history.
They sold off Weston Foods.
Exactly. They sold the very bakery business the entire empire was founded on.
Which feels crazy, right?
Sure.
George Weston started as a baker in 1882.
It feels like selling the soul of the company.
Yeah. But by 2021, they realized they no longer needed to physically bake the bread.
Why bake it when you control the entire market it sells in?
Right. They had realized that the true, unassailable power lay in controlling the physical space where the bread is sold.
And owning the data of the millions of people buying it, they transitioned into a, quote, pure play retail and real estate giant.
The blueprint was finalized. They had built an opaque, vertically integrated fortress.
Okay, so by the late 1970s and into the modern era, they've built this impenetrable structure. They own the supply chain, they own the shelves, they dominate the market.
Right.
But just having a large market share doesn't automatically guarantee record-breaking profits year over year.
No, doesn't.
So how did they actively manipulate that chain to extract more money from the consumer?
Well, this brings us to a vital case study in how consolidated market power operates in practice. We have to look at the Canadian bread price-fixing conspiracy.
It's one of the most chilling examples in corporate Canadian history.
We are looking at a 14-year period. 14 years, running from late 2001 to March 2015.
A decade and a half.
Every single time a Canadian bought a loaf of packaged bread, we are talking Wonder Bread, D'Italiano, Country Harvest, store-brand bagels, English muffins, They were paying an artificially inflated price.
Every single time.
The Competition Bureau documents state that at least $1.50 was added to the price of a loaf of bread over this period.
And when you multiply that by millions of people over 14 years,
The estimated cumulative cost to the Canadian public is $5 billion.
$5 billion. The mechanics of the scheme were referred to by industry insiders as the 710 Convention.
The 710 Convention, it sounds so clinical.
It was a highly synchronized mathematical mechanism.
Break down how it actually worked on the ground.
The competing wholesale producers, specifically Weston Foods and Canada Bread, would coordinate a 7-cent price increase at the wholesale level.
Okay, so the cost to buy the bread goes up by 7 cents.
Right. This was then immediately followed by a coordinated 10-cent price increase at the retail level across all the major grocers.
So Loblaw, Sobeys, Metro, Walmart, and Giant Tiger, all of them.
Yes, they all jumped 10 cents.
Can we pause and unpack the math of that 7-10 split? Because it really reveals the cold calculus of the whole scheme.
It's fascinating math.
Why exactly 7 and 10? What happens to the profit margins there?
It is a brilliant piece of structural math. Let's say the wholesale cost of a loaf is $2 and the retail price is $2.85.
Okay.
The retailer is making roughly a 30% gross margin.
Right. Standard grocery margin.
Now, if the producer raises the wholesale price by 7 cents and the retailer raises the shelf price by 10 cents,
The retailer preserves their standard 30% profit margin on the new higher price.
exactly. But the producer, the companies actually initiating the price hike, capture 70% of the overcharge.
Oh, wow. Think about how perfectly that aligns everyone's incentives.
It's a perfect cartel.
The retailers don't lose a fraction of a percent of their margin, and the producers vastly increase their revenue. No one in that chain has a financial incentive to blow the whistle.
But how do you actually enforce a conspiracy like that across the entire Canadian grocery sector for 14 years?
Yeah, that's the tricky part. You have supposedly fierce competitors sitting in the same market.
Right. How do you ensure that one grocer doesn't just say, you know what, I'm going to eat the 7-cent wholesale increase, keep my retail price the same, and steal all of Loblaw's customers?
Well, they used a strategy called follow the leader.
Ah, follow the leader.
The wholesale suppliers essentially acted as the enforcers for the cartel. A supplier like Weston Foods would approach one retailer, say Sobeys, to signal a coming price hike.
Okay.
If Sobeys agreed to raise their shelf price, the supplier would then take that commitment and use it as leverage to force Loblaw, Metro, and Walmart into alignment.
So the supplier is playing the middleman?
Yes. The retailers would literally demand that the suppliers actively manage the retail competition to ensure nobody undercut the new artificially high floor.
The source documents use the term offside. No retailer wanted to be offside.
Right, nobody wanted to be the first to raise prices and look expensive, but absolutely no retailer wanted to be left out of the profit once the floor was raised.
The filings identify 15 specific dates of coordinated price action over those 14 years.
15 separate orchestrated hikes. But there's a fascinating incident in 2012 that highlights just how fragile, but also how aggressively maintained this cartel was.
Yes, the 2012 incident is incredibly revealing.
What happened?
Weston Foods had internally scheduled a price increase, but they failed to announce it to the market in time.
They missed their window.
Exactly. Consequently, their supposed competitor, Canada Bread, had to cancel their own planned price hike.
Because they couldn't go it alone without being offside.
Right. The court filings detail how, shortly after this, a Canada Bread employee approached Weston Foods staff to express their extreme displeasure over the failed hike.
Wow. They were mad they couldn't raise prices on the public.
This created what the documents describe as a sense of urgency to restore alignment and force the price up in October of that year.
It shows that this wasn't just some passive understanding over golf. It required active, aggressive, interpersonal maintenance.
It was an active cartel. And then the house of cards falls.
Or, more accurately, it is strategically dismantled from the inside.
Yes.
In March 2015, Loblaw and George Weston Limited self-reported the entire conspiracy to the Competition Bureau.
They just walked in and confessed.
They approached the federal government and admitted to a 14-year industry-wide price-fixing scheme.
We must analyze the game theory of this confession because it is crucial to understanding corporate liability.
Okay, let's break it down.
By being the very first party to self-report, Loblaw and George Weston utilized the Competition Bureau's immunity program.
Which has some very stark rules.
Very stark. The rules of that program are The first party to confess and provide evidence secures complete immunity from criminal prosecution and penalties for themselves and their executives.
Complete immunity. Let's look at the outcome of that objectively.
It's astounding.
They participated in a $5 billion extraction of wealth from the Canadian public. And when they decided the risk profile had changed, or maybe they felt the Bureau was getting too close,
They turned state's evidence.
they completely shielded themselves from criminal charges while simultaneously bringing the hammer down on their competitors.
Yeah, let's look at what happened to the competitors.
Canada Bread, which had since been acquired by Grupo Bimbo, was fined $50 million in 2023.
Which is the highest price-fixing fine in Canadian history.
And they were banned from bidding on federal contracts for a decade.
It is a masterclass in strategic liability management. The architects of the system walked away without criminal records, while their rivals absorbed the criminal penalties.
And we see the ultimate resolution of this for Loblaw in the civil courts in 2024 and 2025.
Right, the class action lawsuits.
To resolve the class action lawsuits in Ontario and Quebec, Loblaw and George Weston agreed to a $500 million settlement.
$500 million. Let's look closely at that number because the structure of the settlement is fascinating.
It's not just a straight check, is it?
No, it's structured as $404 million in cash, plus credit for $96 million in $25 gift cards that Loblaw issued to consumers way back in 2018.
Oh, I remember those gift cards. Everyone was signing up for them online.
That gift card campaign was essentially a massive public relations maneuver, and they successfully negotiated to have that PR cost deducted from the final legal settlement.
So they got credit for a PR stunt. I mean, if the architect of an estimated $5 billion price-fixing scheme pays a $500 million civil settlement and receives absolute criminal immunity,
The math is pretty clear.
from a purely objective standpoint, is that a penalty? Or is that just an incredibly favorable retroactive cost of doing business?
From a purely financial perspective, the math is undeniable. If an enterprise yields billions in illicit revenue over a decade and a half, and the ultimate exit cost is essentially 10 cents on the dollar.
With zero criminal records for the executives involved.
Exactly. The market incentive to engage in such behavior is not deterred. It is economically validated.
The legal system processed the crime, but the economics of the crime remained highly, highly profitable.
The consumer pays the inflated price for 14 years. The corporation pays a fraction of that back a decade later, and the architecture of their market dominance remains completely intact.
Completely intact. But if you are a corporation generating billions of dollars in retail revenue and capturing hundreds of millions in coordinated overcharges, you have to protect that capital.
You have to manage your wealth.
You have to minimize your tax burden. And it turns out the ingenuity of this empire was not limited to the grocery aisles of Toronto or Halifax.
No, it extended much further south.
It extended to the Caribbean. Let's open the offshore ledger and look at the Glen Huron bank tax dispute.
To understand the Glen Huron case, we have to look at the intersection of corporate finance and international tax law.
Okay, set the scene for us.
In 1992, a subsidiary named Loblaw Financial incorporated an entity in Barbados called Glen Huron Bank Limited.
They started a bank.
Yes, they secured an offshore banking license from the Central Bank of Barbados.
Let's be very clear about what kind of bank this was, because if I'm a citizen living in Barbados, I cannot walk into Glen Huron Bank, open a checking account, and ask for a mortgage.
No, absolutely not. This was a corporate bank.
Between 1992 and 2000, Loblaw Financial and the broader Loblaw Group injected massive amounts of capital into Glen Huron.
Millions of dollars.
The bank then managed corporate investments, short-term debt securities, and cross-currency swaps.
Exactly. It was a treasury management vehicle.
Wait, pause. Cross-currency swaps. I'm visualizing myself buying a carton of milk and a prescription at Shoppers Drug Mart.
Great.
Why does my local grocery conglomerate need to trade foreign debt and execute cross-currency swaps in the Caribbean? What does that actually mean?
It's a great question. A cross-currency swap is a financial derivative.
Okay.
It's an agreement between two parties to exchange interest payments and principal on loans denominated in two different currencies.
Give me a real-world example.
Let's say Loblaw, as a massive multinational, has debt in US dollars but generates most of its revenue in Canadian dollars from their grocery stores.
Okay, I felt.
If the exchange rate fluctuates wildly, their debt becomes much more expensive to service. So they use a swap with an international bank to hedge that risk, creating their floating rate for a fixed rate, for instance.
It is highly complex corporate treasury management.
And Glen Huron was essentially acting as an in-house investment bank for the Loblaw empire to manage these kinds of complex financial instruments.
Okay, that makes sense on a corporate scale. So where does the government take issue with this? Why did it end up in court?
The dispute centers around the taxation years between 2001 and 2010. During this entire decade, Loblaw did not report Glen Huron's massive income as foreign accrual property income, or FAPI, on its Canadian tax returns.
FAPI. It sounds like an obscure technicality, but it is the absolute cornerstone of how Canada attempts to tax money that corporations move offshore.
It's a critical piece of the tax code.
The general rule of FAPI is that if a Canadian parent company has a controlled foreign affiliate making passive income offshore, that income must be taxed in Canada as if it was earned here.
Right, it's designed to stop companies from just parking their profits in tax havens like Barbados to avoid Canadian taxes.
But Loblaw claimed they didn't have to took a cent of Canadian tax on Glen Huron's income.
Because they argued they met something called the financial institution exception.
What is that?
The financial institution exception is an incredibly specific, narrow carve-out in the tax code.
Okay.
To qualify, the foreign affiliate must be a regulated bank under foreign law. It must have more than 5 full-time employees.
Which Glen Huron did.
Right. And crucially, its business must be conducted principally with persons with whom it deals at arm's length, meaning unaffiliated, independent third parties.
And this is exactly where the Canada Revenue Agency, the CRA, stepped in.
The CRA audited them.
The government audited Glen Huron and argued that Loblaw was essentially doing business with its own subsidiary.
Yes, the CRA looked at the structure and said, the parent company in Canada is injecting all the capital, and the parent company is exercising close corporate oversight over the investment strategies.
Therefore, the CRA argued, Glen Huron did not meet the arm's length requirement. It wasn't an independent bank. It was an extension of Loblaw.
And based on that, they reassessed Loblaw for $475 million in unpaid taxes.
$475 million. This triggered years of intense, high-stakes litigation.
It went on for a decade.
The Tax Court of Canada actually initially agreed with the government. The trial judge looked at the massive oversight from the Canadian head office and concluded that Glen Huron and Loblaw were not operating at arm's length.
The capital injections and the strategic direction from Toronto meant the exception shouldn't apply, according to the lower court.
But Loblaw appealed, and the case wound its way all the way to the Supreme Court of Canada.
And in December 2021, the Supreme Court handed down a unanimous 7-0 decision.
They ruled entirely in favor of Loblaw.
Entirely. The Supreme Court's reasoning is a fascinating study in statutory interpretation.
So,
Justice Cote, writing for the unanimous court, noted that the FAPI regime is one of the most complicated statutory regimes in Canadian law. The ruling hinged on a strict, literal, textual interpretation of the phrase, doing business.
So what exactly did the Supreme Court say was the difference between a parent company managing a subsidiary and doing business with it?
The court determined that merely providing capital to a subsidiary and exercising corporate oversight over its general direction does not constitute doing business in the strict legal sense required by the statute.
Because the transactions themselves were with third parties.
Exactly, because the actual day-to-day investment transactions, the buying of short-term debt securities, the execution of those cross-currency swaps were conducted by Glen Huron's employees in Barbados with third-party international banks on the open market.
So the court ruled that 86% of Glen Huron's income came from arm's-length parties.
Right. The oversight from Toronto didn't legally taint the arm's-length nature of the swaps themselves. Therefore, the financial institution exception applied perfectly. Loblaw owed nothing.
I look at this case, and it reminds me of a high-stakes poker game where the house wrote a ridiculously complicated rulebook, and the player simply hired a team of lawyers to memorize every single footnote and exploit the exact phrasing of the text.
Well, we have to differentiate here between tax evasion and tax avoidance.
That's an important distinction.
Tax evasion is hiding money and breaking the law. Tax avoidance is the legal minimization of tax liability through strict compliance with the letter of the law.
And this is avoidance.
Yes. The Supreme Court stated explicitly in their ruling that taxpayers are entitled to arrange their affairs to minimize tax payable. This wasn't a crime.
It was a legal masterclass in utilizing the exact text of a highly complex law to shelter $500 million perfectly legally.
Exactly.
But consider the contrast for a moment. If you are an everyday citizen, you face immediate, non-negotiable tax deductions on your paycheck every 2 weeks.
You don't get to debate the definition of your income.
No. Meanwhile, multinational corporations can engage in decade-long litigation over the precise legal definition of the phrase doing business and win.
And win big.
And what happened to that massive pool of offshore money? Huron was dissolved in 2013, and its liquidated assets, hundreds of millions of legally untaxed dollars, were brought back to Canada.
And what were they used for?
They were utilized to help finance Loblaw's $12.4 billion acquisition of Shoppers Drug Mart.
They used the legally protected offshore capital to buy the country's largest pharmacy chain,
dramatically expanding their domestic retail footprint and further consolidating their market power.
It is a perfect closed loop of capital optimization.
So the capital is brought home and deployed. They buy Shoppers Drug Mart. They expand the footprint.
Right.
But if you are pouring billions into expanding this massive retail empire, how do you ensure that your investment is safe?
You have to protect the physical locations.
Exactly. How do you guarantee that your newly acquired pharmacies and grocery stores have a captive audience and face no local threats? Well, you don't just own the physical stores. You control the ground they sit on.
Which brings us to the invisible walls of Canadian real estate.
Let's go back to 2018. As we noted earlier, George Weston Limited reorganized. Loblaw spun out its real estate holdings to create Choice Properties, Real Estate Investment Trust, or REIT.
This singular move transferred 69 million square feet of prime commercial real estate directly to the parent company.
I want to understand the mechanics of a REIT. Because if Loblaw essentially owns the buildings it operates in, why spin it out into a separate trust that then charges the grocery store's rent?
It's about shifting profitability.
How does that work?
A REIT is a brilliant financial vehicle for a vertically integrated company. By spinning the real estate into a separate entity that the parent company controls, the corporation can shift profits from the traditionally low-margin grocery business into the high-margin real estate business.
Okay, walk me through that on an income statement.
Here is how it works. The grocery store pays massive monthly rent to Choice Properties. On Loblaw's balance sheet, that rent is a massive operating expense, which artificially lowers their grocery profit margin.
Ah, I see.
So if politicians or the public complain about the exorbitant price of food, the grocery executive can point to their balance sheet and say, look, our margins are incredibly tight. We only make 3 cents on the dollar.
But what they obscure is that a massive portion of their operating costs are rent payments flowing directly back to their own parent company's real estate arm.
It perfectly shields their true profitability. The source documents show that Choice Properties receives roughly 58% of its total revenue directly from Loblaw leases.
It is a completely closed-loop financial system.
But the control of the physical land goes far beyond just charging yourself rent to hide grocery profits.
Right. It involves powerful legal mechanisms known as property controls.
Property controls are the invisible walls of the Canadian grocery sector. There are 2 primary weapons used here: restrictive covenants and exclusivity clauses.
Let's define these clearly because they sound like zoning laws, but they are entirely private contracts.
Exactly, they're private. A restrictive covenant is a private restriction registered directly on the title of the land itself.
Okay.
Let's say Loblaw owns a piece of land, operates a grocery store there, but eventually decides to close that store and sell the land.
Right.
Before they sell it, they attach a restrictive covenant to the deed that legally prevents any future owner from ever operating a grocery store or a pharmacy on that site.
It's permanently attached to the land.
Yes. An exclusivity clause, on the other hand, is placed in a commercial lease.
How does that one work?
If Loblaw is the anchor tenant in a large shopping plaza, their lease will dictate that the landlord is strictly prohibited from leasing any other space in that plaza to a competing food retailer, a butcher, or a baker.
The analogy that makes this click for me is cars. It's like selling your used car to someone, but forcing them to sign a legally binding contract that says they, and anyone they ever sell the car to in the future, is never allowed to drive it on a highway.
That's a great analogy. You are exerting massive control over an asset long after you stop owning it.
And the impact of these controls on communities is profound. They literally dictate the geography of food access in Canada. They create artificial food deserts.
The Competition Bureau specifically highlighted this in their 2023 grocery market study.
Right. They pointed to a case in Crow's Nest Pass, Alberta.
Sobeys, which is a major competitor that utilizes the exact same real estate tactics as Loblaw had placed a restrictive covenant on a property.
And what happened?
That single legal clause successfully blocked any new grocery store from entering the entire community from 2017 onwards.
If you're listening to this and thinking, well, I just won't shop at the monopoly store, I'll go to the independent grocer, or I'll wait for a European discount chain to open up, the Competition Bureau actually looked at that.
They did. The Bureau concluded that these property controls are overwhelmingly used to insulate dominant firms from competition.
They lock out new entrants.
They prevent independent local businesses from expanding, and they create practically insurmountable barriers for international discount chains like Aldi or Lidl.
Those international discounters might look at Canada and want to enter the market to compete on price, but they simply cannot find prime urban real estate.
Because the land titles of all the best locations are heavily encumbered by these covenants.
It is territorial control disguised as property rights. If a major grocer leaves a neighborhood, they use the legal system to ensure that no one else can ever feed that neighborhood from that location.
It's like salting the earth.
Now, the Competition Bureau has recently gained more regulatory teeth. Following amendments to the Competition Act, the Bureau actually launched formal investigations into both Sobeys and Loblaw in 2024 regarding these specific property controls.
The new laws allow the Bureau to challenge agreements, even between non-competitors, like a landlord and a grocery tenant, if a significant purpose of the agreement is to lessen market competition.
And we are seeing the immediate result of that legal pressure. In June 2025, Loblaw made a public commitment.
They agreed to voluntarily stop entering into new restrictive covenants.
Which is a start.
They also agreed to waive exclusivity clauses in communities where they operate the only grocery store and to stop blocking subset retailers like independent butchers, bakeries, or produce stands from opening near them in shopping plazas.
The Bureau views this as a major milestone for competition, but I have to play devil's advocate here.
Okay.
Even with Loblaw's 2025 concessions, hasn't the fundamental damage already been done?
In terms of the map,
Yeah. If a single corporate lineage has spent over a century writing these restrictive covenants into the land titles of prime commercial real estate across the country, hasn't the geographical map of Canadian retail already been permanently gerrymandered?
you're not wrong.
Agreeing to waive future covenants doesn't magically erase the invisible walls that have already been built over the last 100 years.
That is the enduring power of real estate monopolies. You are entirely correct. The structural advantages embedded into the physical landscape over decades do not simply evaporate because of a prospective policy change.
The prime locations are secured.
The optimal intersections are locked down. The barriers to entry for a new national competitor to build a viable footprint remain exceptionally high.
This entire architecture of control, from the wholesale bakery meticulously coordinating the 710 convention, to the offshore bank sheltering $500 million through statutory loopholes, to the very asphalt in the parking lot restricted by private covenants, it all has a singular purpose. It ultimately trickles down to two places. It trickles down to the price tag on the shelf, and it trickles up to the executive compensation package. Let's look at the final piece of this structure, the toll on the citizen.
To understand the human impact of this corporate architecture, we must look at the stark economic reality of 2022.
Right, the inflation crisis.
In 2022, Canadian food inflation hit 9.8%. This was the fastest pace of food price increases recorded since 1981.
Consumers were feeling intense financial pain every single time they approached a checkout counter. Real wages were stagnant, but the cost of basic sustenance was skyrocketing.
And while the consumer was experiencing generational, agonizing inflation, let's look at the balance sheet of the leadership.
Galen G. Weston, the chairman and CEO, saw his total compensation for 2022 hit $11.8 million.
That is an 11% increase from the year prior.
Even more staggering, his Loblaw-specific compensation jumped 55% in a single year, reaching $8.4 million.
We have to analyze exactly how that compensation is structured because corporate compensation structures dictate executive behavior.
Okay, how is he paid?
The vast majority of Galen Weston's compensation, over 85% of it, is delivered in the form of stock options, share-based awards, and performance bonuses tied to financial targets.
His base cash salary is a relatively small fraction of his total wealth generation.
Yes.
And why does that matter for the person buying bread? Because when an executive's wealth is heavily weighted in shares, their primary fiduciary duty, their primary personal financial incentive, is not to the consumer.
It is not to lower the price of bread.
Their duty is to increase the stock price.
Exactly. The inflation crisis presented a mathematical opportunity for the architecture we have described. If you control the supply chain, if you control the real estate, and if you control the retail floor, you can manage the inflationary pressure to your advantage.
And we see this explicitly in the phenomenon known in the industry as the supplier squeeze.
The supplier squeeze is ruthless.
How does the supplier squeeze actually work in practice? If I'm a mid-sized company making pasta sauce, how does Loblaw extract margin from me?
Loblaw utilized its dominant market power to unilaterally dictate terms to its suppliers. The source documents show Loblaw imposing new supply chain charges on vendors just to stock their products.
So they charge the vendor a fee just to be in the store.
They altered contracts to demand higher listing fees, and crucially, they routinely refused to acknowledge the manufacturer's suggested retail prices, the MSRP.
So the pasta sauce maker says, my costs went up, you need to sell this for $3. And Loblaw says, no, we're selling it for $3.50, and you're going to pay us a fee for the privilege of keeping it on the shelf.
Precisely. They set the retail price they wanted to maintain their margins, and they forced the suppliers to absorb the cost of doing business with the monopoly.
It's incredible.
By squeezing suppliers on one end of the chain and strictly maintaining their profit margins on the retail end, the math inevitably works in their favor.
Because during inflation, the base cost of goods goes up. If your margin percentage remains fixed, the absolute dollar value of your profit increases.
The stock price soars, and thereby executive wealth soars.
The value of Galen Weston's personal eligible holdings in George Weston Limited climbed by hundreds of millions of dollars over the course of that single year, reaching $1.29 billion.
Picture the consumer at the bottom of a massive century-old funnel.
The funnel, yeah.
Every time a supplier is forced to pay a new fee to access the shelves, every time Choice Properties charges rent to a Loblaw store to lower the grocery margin, every time a fraction of a cent is coordinated in a wholesale pricing scheme, all of it flows upward.
The capital flows out of the wallets of citizens facing 9.8% inflation, up through the opaque corporate matryoshka doll, past the offshore ledgers in Barbados, and directly into an $11.8 million compensation package and a billion-dollar stock portfolio.
The structure operates exactly as it was designed to operate. It is highly efficient at extracting value from the base of the economy and consolidating it at the apex.
We have mapped the anatomy of this empire. From the 1919 introduction of the self-serve groceteria shifting labor to the buyer, to the precise mathematical extraction of the 710 bread convention.
The architecture is complete.
From the legal masterclass of the Glen Huron offshore accounts defining the boundaries of tax avoidance, to the invisible walls built by property covenants, it is a system perfectly designed to operate within the bounds of the law, and perfectly capitalized to easily afford the civil settlements when it occasionally steps over the line.
It is the ultimate testament to the power of vertical integration and relentless multi-generational consolidation.
We've looked at the cold facts of how this empire dictates the price of your bread, the location of your pharmacy, and the survival of independent suppliers. But here is something to mull over the next time you walk down a grocery aisle, the next time you look at that receipt. If a single corporate lineage has spent over a century legally rewriting the rules of real estate, taxation, and supply chains to ensure they never truly have to compete, at what point do we stop calling it a free market and start calling it a private infrastructure?
The headlines fade. The paper trail remains. This is Fault Line Ledger,